Coming up on this week's episode of Check Your Balances, we talk about how you can buy a frothy private company and some new IRS guidelines. Stick around. That's coming up next.
Check Your Balances is a show produced and owned by Craftwork Capital. The views expressed by the hosts and their guests are personal opinions and should not be considered personal financial advice or the opinion of Craftwork Capital. All investments have risk and may lose money. Consult with your financial advisor, tax preparer, or attorney prior to implementing anything discussed, and please do not use this show as the sole basis for financial decisions.
Welcome back to another week of Check Your Balances. I am Ross Anderson, joined as always by my friend and co-host, Dan Maseka. We're having a toasty little day for early spring, late spring. I don't know what we call this. It's still April when we're recording this, and it's 84 degrees outside.
Yeah, it's hot. You know what, though? I like it. It's a nice change of pace from what we've had. And in particular, I love those mornings where you can be outside without a sweater and just like hang out and have your coffee. I mean,
I agree. My favorite weather all year is typically the fall, and I want like t-shirt during the day and like sweatshirt and jeans at night. Like that's kind of where I want to be in terms of my comfort level. It just feels like we skip the best seasons in DC, or we make them very, very quick. You get like 3 days that it's really nice, and then it goes to blistering hot. I'm not here for it. I'd rather it be cooler longer, but you know, that's me. I'm cranky. Everybody loves summer. I'm like the only one that can't wait for winter to come. So I get it that I'm a weirdo in this sense, but not pleased with how hot it is outside. My Nordic blood doesn't like it.
Yeah, that could be it.
So a couple things going on that we wanted to get into today, none of which completely had a full episode worth of us bantering about it. But I want to start by highlighting a recent episode of ours that I think is going to play into this, which is our valuation show with Ryan Hutchins. So our downloads on that show were kind of low for what they normally look like on a week-to-week basis. Sometimes that's just because people are traveling, spring break, whatever. But if you missed that show, I'm going to put in a plug to go back and listen to it because I thought it was fantastic. I think talking about how businesses operate, how they're valued, has deep implications for how we think as investors. And we're going to try and cover it again from more of a public markets-facing lens on an upcoming episode, but that show was really specific to private businesses. And I just wanted to put in a plug that if that was one of the ones you skipped over because it didn't sound that interesting to you, we really enjoyed that conversation. We appreciated Ryan's take, and just a plug to go back and check it out.
Yeah, it's not often you get that kind of inside view of private businesses, but he gets so many looks at businesses that we only have to imagine what's happening under the hood. So I was captivated during that whole conversation and really enjoyed it. So I'll echo Ross's plug for that episode, and maybe we'll have Ryan back on one day.
And that leads us into the first thing that we're talking about today, which is some of the mechanics of exchange-traded products. We're going to try not to go too off the rails here, but the reason this is coming up, and I wanted to plug our show about private businesses, there's a desire to invest in the things that we can't invest in. For whatever reason, having it just out of reach somehow seems to make us want it even more. When retail investors find out that there's a tier called accredited investors, that if you've got a certain level of income or a certain level of wealth, that you can buy products that aren't even legal to sell to you as a retail investor. You're like, dang it, that's where they keep the good stuff. And then if you're an accredited investor, you find out that there's another tier called a qualified purchaser that is a separate threshold that is not available to you. These are things that can't even be advertised to you in most cases. We don't even know where they keep the good investments for the billionaires.
It's like the Birkin bag of investing.
Yeah. These things that are out of our reach in the retail world seem to have an allure that that's where the good stuff is. And in some cases, that might be true. Private equity, venture capital, some of the things that we're talking about in that institutional investing space that have incredibly high upside because they can get in at the seed round level or at the, Series A level of funding, things of that nature. Well, there's some new ways to participate in companies that haven't gone public yet. And there is a new exchange traded product I hope we don't get in trouble for talking about a specific exchange traded product, but this is, we're going to talk mostly about this fund called the Destiny Tech 100, the ticker's DXYZ. And the reason we're talking about it is because it listed about a month ago. And the top holding is a company that you can't buy on the public markets, which is, I already forgot what it is.
SpaceX.
SpaceX, thank you. I knew it was an Elon Musk company.
One of those guys.
Yeah, one of those. So SpaceX. So if you think SpaceX, oh my gosh, I hate the pun. I'm going to say it anyway. If you think SpaceX is going to the moon, please don't hate me. Please don't turn our show off right now because I just said that. That's embarrassing. If you think SpaceX is the next mega winner, you can't buy it. It hasn't listed. It hasn't IPO'd. But this fund owns shares of SpaceX. And by all accounts, if you're not paying attention, it looks like it trades just like an exchange-traded fund, like SPY buys the S&P 500. It looks and operates like that, but there's some big differences.
Right, exactly. So let's unpack that a little bit and understand what happens when I'm buying a share of SPY or when new shares are created versus what's happening behind the hood when you're trading something like this Destiny Tech 100 and buying shares of that. So when you're purchasing, when money is going into a product like an S&P 500 index fund or ETF, right? The flow in or out is different day by day. And what happens when they have extra money, they're taking that money and basically buying the underlying index. S&P 500 is supposed to have exposure to the 500 largest stocks traded in the US. They're going to take the money that comes in, buy accordingly those 500 stocks with those funds so that you have that exposure. They're able to manage this exposure because those stocks are publicly listed. They have very large markets, and this varies as ETFs scale to smaller size. They have people on the back end who are trying to maintain that right level of exposure and trying to get efficient trading for you.
So basically, the function of that means you're kind of a pass-through vehicle to buying all of that stuff, right? Like you're buying a fraction of a share of every single company in the index. Now, mechanically, when you go to buy your S&P 500 ETF, maybe they're doing that or maybe they're not behind the scenes. You don't really know because there's a bunch of shares exchanging hands. It's going from me to Dan or Dan to me or our clients to somebody else's clients. All of that's happening frequently. So it might just be that they're changing hands.
Right.
When there's enough money coming in that they're going, well, wow, there's more demand than there are shares. They create new ones.
Right. And the pricing is largely going to follow the underlying pricing of the stocks within that index too. It's a very efficient marketplace. And you know that. You know that the underlying value of that index is X. They're trading for Y. Those figures should be fairly close because of how large those companies are and how efficient it is to trade an S&P 500 ETF or index.
Correct. And on any ETF, whether you're looking at SPY or we mostly use Vanguard stuff for a lot of our broad-based things or VOO or any other index, what you can look at there is basically the drift from how close does it track the index itself. Is there any tracking error? Is there any kind of shift in terms of the mechanics and how good are they doing? For the average person, do they care? Probably going back to our fractions of a penny that you might get chewed up in the broker wars and the payment for order flow stuff. Maybe you say, I don't care. For us, it's part of our due diligence process that we have to look at that stuff. We have to review it. We have to make sure that we're buying the best version of the product that we can find. And whether or not you're going to give up a concession, it doesn't have to be the best tracking error product, but it has to be the best all-around experience in terms of how it trades, the fees, all of that type of stuff. So that's what we're looking at when we evaluate an ETF. This Destiny fund, is completely different. It's completely different. It looks and trades just like an ETF. So the same way that you would buy SPY or VOO or VTI or anything else on your brokerage account, you would go in and place an order to buy or sell this thing. But behind the scenes, it's completely different.
Right. So when we described an S&P 500 index, we talked about like market makers, essentially, people who will go and deal with the underlying securities by buying or selling as needed to keep the fund with the right exposure for you. So you're getting something that looks like the S&P 500. This other thing we're talking about trades largely in private companies. So there is very limited or no market for those securities. Therefore, it trades very differently than something like a broad-based index fund. And it's the pricing of this is going to be largely dictated by supply and demand of the shares of that exchange traded product.
So there are no shares created or deleted. That's the key. So normally, if you've got a bunch of people trying to buy an S&P 500 ETF and not enough people want to sell it, they just create new ones, or same thing, they delete shares when there's too much selling demand. They just get them out of there. They liquidate the position. So you're getting very, very transparent kind of matching ownership with the index at all given times. This is basically you only changing hands with other people that own the shares. There is a fixed number of shares, which is, by the way, how trading an individual company works. It's just that there's also market makers that kind of grease the wheels there, and there's a bunch more liquidity in most S&P 500 or kind of actively traded stocks. So in this thing, if nobody wants to buy it, your bid goes up and up and up and up and up, potentially to a limitless level if you're willing to buy it at that, or somebody's willing to sell it to you. And what that creates is basically a huge spread right now. I think at the moment, the spread is at 5 times the value of the assets. And at one point, it was up to like, presumably like 50 to 100 times the value of the assets almost. And the product doesn't have to respond. So this exchange traded product came online. I believe it's currently worth, the underlying is worth about $5 a share as of whatever the most recent valuations are. And the product went up to almost 100, just shy of $100 a share, purely based on the demand to be a part of investing in SpaceX, is really how I'm reading it. There's other companies in there that are also tough to access. But this is what's called a closed-end fund, which means no new shares are being created or deleted. And so if you're looking at this going, this is my chance to get in on a SpaceX, the truth is that, yes, that is true, but you also might be paying 5 times more for it than what the private equity folks paid for it. You may be creating liquidity for them at 5 times its current value, and they've chosen to put those shares into this product, which might be how they're creating liquidity on their side. So you got to be really careful with something like this, that even though it looks and sounds like something you're familiar with, that this is just a whole different beast.
Yeah, and we're talking specifically about this product. There are other funds on the market that do give you exposure to privately held companies that I think are interesting, and quite frankly, I think there are some that do it better than this one, that mix public and private businesses as well. So it's exciting that there is opportunity to do it. It's just important that you know how the products work and what you're paying. As you were talking, I tried to come up with an analogy, and for some reason, my mind was stuck on pizza. I don't know if I'm hungry. It's also the end of Passover, so I'm eyeing my first pizza in over a week. And I was thinking of like a pizza store, like the S&P 500 index is like a pizza shop that's cranking out new pizzas. You place an order, they're going to make a pizza and sell it to you, versus, this is a terrible analogy, I told you. I'm thinking of my college days where you'd go to the bar and they'd be like, this is the only pizza we have. And they'd like make you pay whatever you were willing to pay for it. And whoever had the highest price would get the
bar that was auctioning pizzas.
Basically, I thought it was horse crap at the time. And I think even in retrospect, it was, but they'd be like, this is what we have. It's like, you'll pay what we'll take whatever we can get for it. And that's almost like the exchange traded product. And if it's 2 a.m. and everyone's drunk and hungry, they'll make a lot of money for the pizza. If it's 1 o'clock in the afternoon and no one cares about your pizza and they'll go to Domino's down the street, then, maybe it's worthless.
I both like appreciate the capitalism of that and also hate those people.
Oh yeah.
That makes me deeply angry. And I also like can respect it for being like the ingenuity to it, but also like you're bad humans.
Oh, we were like shouting in the place at night. I'm sure they didn't love it, but they brought it on themselves.
The wrap up there is be careful. If it is a closed-end product, closed-end products aren't new, by the way. This isn't the first one. There's many of these. These get used for stuff that you just can't do because of the mechanics of an open-ended mutual fund. So things where you see this a lot are like levered bond funds, especially when bond yields were like really, really unattractive and money was cheap. You would see a closed-end fund say, okay, well, we're going to borrow this cheap money, lever up this bond fund so that we can pay a 5 or a 6% yield that investors are going to be attracted to, rather than the 2 or 3% yield that those bonds would have done on their own. Those types of things have existed for a long time. They're just not as popular in the States, I don't think. I think they tend to be a little bit more advisor-driven because of how they operate. Again, we don't use those much. I've experienced them before in the past, but it's something to be careful about. And if the only headline that you hear is this is how you buy SpaceX, you could get yourself in a lot of trouble buying it for 5 times or 100 times what the last guy bought it for. So be careful there. Look at the premium or discount that it's trading at. I think you can see you can definitely see it on Morningstar. Again, free Morningstar.com, nothing fancy or advisor side. I think you can see it probably on Yahoo as well, what the premium or discount is. So look at what it is trading relative to the value of the underlying assets. You got to have some faith in that underlying valuation too, but it's not nonsense. They do have to report the NAV or the net asset value of the underlying stuff. So,
right, and maybe it's worth it, maybe it's not. We also have to take it with a grain of salt that shares aren't being issued often of those private companies, so there is going to be some drift versus the most recent reported value.
Totally, yeah. You're going to see some basically pricing that is just representation of people disagreeing about the value, which is what the stock market is doing all day, every day. And maybe that's where the premium settles in on the agreed upon real value of those assets. But you could also be paying way more than what they're worth if you don't already have an opinion. So just know what your opinion is before you buy it.
It's worth noting, I think we could talk about share price because we've referenced it already, that this Destiny Tech 100 today is trading for a little bit north of $17. The highest transaction was just shy of $100, and that's all within a couple weeks span. So,
yeah,
it's crazy.
This is a bad joke, but the joke is always like when you see something like that where it's spiked super high and then all the air gets let out of the balloon. Is I wonder if the guy that bought it at 100 has told his wife yet, right? Like somebody bought it at close to 100. Hopefully they got out at 98, but unlikely. Like they could have ridden that entire slide. Somebody top ticked that price. I hope it wasn't any of our listeners.
Yeah.
All right, let's move on. This isn't as big of a topic, but I do think it's relevant. The IRS continues to kick the can on the Secure Act. Dan, I think you were less excited about this topic for our show. Do you not think people want to hear about our tax planning and what's going on in the IRS world?
I think people do. It just shocked me, the announcement, right? I didn't know about this till you brought it to my attention. And what this references is there was a whole upheaval a few years ago when they did away with the stretch IRA that allowed you to stretch RMDs from an inherited IRA across your lifespan. For many, they condensed it to a shorter period, usually 10 years. The way it read was as if you didn't have to take any distribution on a schedule over those 10 years, as long as you took everything out by year 10. Later on, they clarified that that might not be true for some people, and you do have to take RMDs. A few years ago, they gave forgiveness because it was confusing for a couple years if you missed it. Now it looks like they're giving more forgiveness through this year. And what I thought was crazy is they're issuing this kind of at the beginning of the year, but they're giving forgiveness even through this year. So if you saw the announcement already, you have plenty of time to have taken an RMD this year if you needed to, but they're even giving you a pass on that, which I thought was funny.
So here's what I think is interesting. Okay, so the main rule that's in question here is for somebody that passes that is already past their required beginning date. Okay, so that's for people that have already had to start taking a distribution from their IRAs. They pass away and you inherit their money. And the question is, does it work like the old 5-year rule where you can just anytime in the 5-year window, as long as you take the money out, no problem, we're good? Or do you have to continue to take an annual distribution based on your life expectancy? And then the 10-year rule, the new one, is now layered on top of it. So that's the real thing in question. Does it work like the old 5-year rule where you just have a window and you've just got to deal with it? Or is the old thing still in place, which is what it looks like it is? So there's basically two RMD rules interacting simultaneously.
Right, depending on the original account holder.
Correct. So somebody already had to take RMDs. You have to take one every year plus the 10-year rule. If they didn't have to take RMDs yet, if they have passed before that age, 10-year rule still applies, but that other one doesn't.
This is so stupid.
Now, this is the 4th year in a row that the IRS has basically said, we can't give you an official ruling. Basically, I think, because the IRS can't change the law. If the law is written bad, all the IRS is telling you is whether they're going to enforce a penalty.
That's true. I think that's the most logical explanation for it.
Yeah,
right.
This is an unintended consequence that wasn't supposed to be there. And the IRS is like, what do you want us to do with this? Do you want to fix it? And Congress is like, nope.
Right.
So they are manually just choosing not to enforce this particular law for whatever reason. Here's where this triggers my planner brain. I think if I'm reading this and going, I have another year of relief, I have another year of relief, I have another year of relief, I think the instinct is that people will continue, just like the IRS is kicking the can, they are going to continue kicking the can. I think there's people out there that have inherited IRAs that are now on the 10-year rule that are trying to wait as long as they possibly can. We need to remember that there's a tax law change on the books, like right now. 2026, your rate goes up. So unless your income is going to drop meaningfully, I believe you're kicking the can to your own detriment. Like, unless you expect to make less money in a couple years, the tax law says you're going to probably pay more. Why would you keep kicking the can? Right? Like that to me is the question. Like, why would that be what you're doing if that's really the situation we're in?
Right. And there's certainly some people that won't pay more. Some people will have lower taxes if it reverts back. But if that's not you, not only are you kicking the can to a period where you might be paying a higher rate of tax, you're also compounding the problem because your IRA is presumably growing along the way. And that money will have to come out at ordinary income tax rates too. So it's worth thinking ahead and seeing, is this really the right move for me? Because you're on a 10-year window regardless, if that rule applies to you. You don't get to hold out forever. You have a narrow opportunity to get money out, and you should be thoughtful about it rather than defaulting into something, because that can be a huge difference in money between a structured strategy versus just pulling it all out as soon as they make you.
And Dan, I know you've had clients that have been dealing with this because we've looked at the models. We've been looking at what does it cost us if we do it this year versus defer some and try and there's no perfect answer, by the way. We're working from imperfect data because we don't know what you're going to make. We don't know if they're going to extend the tax cuts. There's a million things we don't know, but that doesn't mean we don't make a decision. We still have to make a decision today about things we don't know, right? So that's the nature of investing. That's the nature of life, is you're going to make a choice today, not knowing how the day ends. So
for sure,
you do have to at least be thoughtful about this. And we know that taxes might go up. We don't know that they will. But to me, I wouldn't be pushing this off as a rule. I would be looking for the general tax planning mantra is look for your lowest bracket possible. Look for the timing. You're choosing the time. You're not choosing whether you're going to pay the tax. You're going to pay the tax. The goal is just to pay it in the lowest bracket possible. This is the same argument that we have with people that go, well, should I convert every dollar of my IRA to Roth? No, because that means you're aggressively going way further than you have to. Yes, every dollar in the future is tax-free, but you're wasting all of those low tax brackets in the future that you could have gotten really cheap money out. It means you're going to push it and go 24, 32, 35, 37. Like, you're going up in the tax rate to go faster. Don't do that. Smooth, baby. Smooth is exactly what we want. nice and easy and steady in terms of your tax planning.
Yeah, for sure. I mean, remember, you get deductions off of your income in retirement. Like there are tens of thousands of dollars you can withdraw from qualified accounts and pay zero tax. So don't waste that.
Yeah.
I'm all for Roth, but
I am too. Yeah, it's like having prepaid taxes, right? That's what the Roth is. It's like having prepaid taxes, which is lovely when you get there until you look back and realize you could be paying 10, 12% on money and you paid 30 on it. Like that's not fun.
Right. Yeah, unless you have a very pessimistic view.
Like converting everything. If you convert everything, you're wasting all of those super low tax bracket years.
Yep.
Anyway, I thought that was worth hitting again. It's like one of my favorite things to talk about on this show.
Yeah, it's a good one. The people like it.
Yeah.
Until they tell us otherwise.
Until they tell us otherwise. We'd love to hear if you like it or what you'd like to hear about. Our inbox is open for questions. We've got mailbag episodes coming up. We'd love to know what you, our listeners, are thinking about, whether it's your personal finances, whether it's things that you're watching other folks deal with and just want an opinion on it. We deal with people's stuff all the time. That's what our show's here to do, is answer some of those questions for you, give you some context on how to think about it. Check your balances at outlook.com is the email address for us. We're also on Instagram. We're on YouTube. We're pretty bad at YouTube, I think, but we're working on it. We're going to try and get better.
Well, yeah, we need a youngin to come in and help us.
Something like that. I'm not sure what we need. You know what it is? I don't want to make it like a visual show, because I think 90+% of the people that interact with our show are sitting in their car right now listening to it.
Mm-hmm.
So I don't want to make it visual first. And I think making it visual first is what's really going to make the YouTube channel pop, is if we make it graphics and video content. But I still want people that are tuning in from their car or wherever you are, on a metro, whatever. I want them to get the best show we can provide. And so I don't really want to prioritize the visual stuff if we don't have to.
That's why I'm holding out on a fancy background.
There you go. It's just Larry David and his crown for now.
Just Larry and the crown.
Thanks everybody for tuning in this week. Hope you enjoyed the show. Join us again next time. We'll see you then.